Okay, so you want to own a liquor store. Rows of bottles catching the light, a steady stream of regulars who need what you sell every single week, and a product that never spoils, never goes out of style, and never asks for a refund. You picture recession-proof cash flow because people do not stop drinking just because the economy gets rough, and maybe they even drink a little more. Sounds simple. It is not simple. Here is what nobody tells you before you sign the lease. Most of what you will sell barely makes you any money at all. The industry you are entering is shrinking for the first time in a generation, and one of the most recognizable liquor chains in America was bought out by a delivery startup gutted from the inside and is now closing stores one by one. So let us take apart what actually happens when you own a liquor store. Let us start with the number that varies more wildly here than almost any other business we cover on this channel. Total startup costs for a liquor store typically land somewhere between $100,000 and $500,000, though a well-built store with a serious build-out can push past $750,000. But here's the part that catches almost every first-time buyer off guard. The biggest single line item is not the building, it is not the fixtures, it is the license itself. Liquor license fees range from under $100 in a wide-open jurisdiction to over $300,000 in a tightly restricted city, because in many states, the number of licenses available is capped by law, which means you are not simply paying a government fee. You are buying a scarce, transferable asset from whoever already holds one. In states that run a quota system, that license alone can represent the single largest expenditure of the entire project. Larger than the real estate, larger than the inventory, larger than every fixture on the sales floor combined. Speaking of inventory, that is where the second wave of capital disappears. Experts recommend allocating 40 to 50% of your entire startup budget just to fill the shelves, which on a typical build translates to somewhere around $120,000 to $150,000 in opening stock. Because unlike a restaurant that can build a menu slowly, a liquor store customer expects a full wall of options on opening day, or they simply walk down the street to a competitor who has one. Add store build-out and renovation running $75,000 or more, specialized refrigeration and cooler systems to keep beer and wine at the correct temperature, a point-of-sale system built specifically for age verification and compliance, and permits running $2,000 to $15,000 on top of the core license. And here is the invisible cost that never shows up in a typical startup budget spreadsheet: security. Liquor stores are disproportionately targeted for theft and armed robbery because they hold high-value, easily resold merchandise and often operate in cash-heavy environments, which means serious security infrastructure, cameras, alarm systems, sometimes reinforced entry points, is not optional spending. It is baked into the cost of doing business from day one. There is also a decision baked into the license itself that most first-time owners underestimate, whether you are buying into a control state or an open license state. And that single choice can shape your entire product catalog before you have ordered a single bottle. In a control state, the government dictates which spirits categories you can even carry, and sometimes sets the wholesale price you pay regardless of your negotiating position, which strips away a lever every other retail business relies on to protect its margin. In an open license state, you have full freedom over your product mix, but that freedom comes paired with direct exposure to enormous category killer chains that can negotiate volume discounts no single independent location will ever match. Either way, the regulatory environment you happen to be born into as an operator dictates a meaningful share of your future profitability before you have made a single business decision of your own. So the shelves are stocked, the license is framed on the wall, and now the daily grind of keeping this business alive begins. Because a liquor store carries a specific kind of fixed cost structure that punishes anyone who underestimates their cash runway. This is operating leverage in a business where the products barely move fast enough to cover the bills. Rent is relentless, running roughly $24 per square foot annually in an average shopping center location. And unlike a restaurant, you cannot simply close early on a slow Tuesday to save on labor, because your entire value proposition depends on customers knowing you are reliably open. Refrigeration alone runs constantly, every single hour of every single day, because a warm cooler of beer is a liquor store's fastest path to losing a repeat customer permanently. Layer on insurance, which for this category includes liability coverage tied specifically to alcohol sales, and layer on a mandatory monthly compliance fee that in some states runs $500 a month starting the day your license is approved, whether you have sold a single bottle or not. And then there is the fixed cost nobody budgets for correctly the first time: cash runway itself. Financial projections for a standard liquor store show a minimum cash runway requirement of 22 months to reach break-even, which means you need enough capital sitting in reserve to survive nearly 2 full years of operations before the business is expected to support itself. None of your rent, your refrigeration bill, your compliance fee, or your insurance premium cares whether foot traffic was strong or weak that month. The lights stay on, the coolers keep running, and the license renewal fee still comes due, regardless of how many customers walked through your door. Payroll adds a quieter but persistent layer on top of all of this, because age verification is not a courtesy in this business, it is a legal obligation with real financial teeth attached. A single sale to a minor can trigger a license suspension lasting weeks or months, effectively shutting off all revenue while every fixed cost we have already covered keeps running in the background. That risk means staff training, compliance software, and sometimes third-party decoy inspections are not optional line items either. They are insurance against a regulatory penalty severe enough to end the business entirely, not just dent a single month's profit. So how does anyone actually make money in a business with fixed costs ticking this relentlessly? This is the popcorn business moment. And in liquor retail, it hides in plain sight on your own shelves. Because not all bottles are created equal, and the product that gets people through the door is rarely the product that pays your rent. Beer typically carries the thinnest margin in the entire store, somewhere between 15 and 28%, and yet it is often the single most important category for foot traffic, because a familiar case of a well-known domestic brand is what pulls a customer in the door on a Tuesday night. Wine tells a completely different story, carrying margins between 30 and 50%, and spirits sit comfortably in the 25 to 35% range, with premium and craft bottles pushing well past that ceiling. Accessories and mixers, the corkscrews, the tonic water, the garnish syrup sitting near the register, can carry margins of 40 to 60%, the highest in the entire building, on products customers barely think twice about adding to their basket. Here is the mechanism that separates a mediocre operator from a genuinely profitable one, and it comes down to a single concept: known value versus discovery pricing. A customer walking in for a bottle of a famous vodka brand already knows exactly what it should cost because they have seen that price everywhere, which means you cannot meaningfully mark it up without losing that customer to a competitor down the street. But a customer looking at a craft bourbon they have never heard of has no reference price at all, which means a bottle that costs you $28 can comfortably sell for $45 because there is no mental anchor telling them that price is unreasonable. Why would a customer accept that markup without blinking? Because unfamiliarity removes their ability to comparison shop, and the smartest operators in this industry have learned to keep known value items priced tight to drive traffic while quietly building their entire profit margin on the unfamiliar bottles sitting one shelf over. Exactly the way a grocery store loses money on milk to sell everything else in the cart. Now here's the trapdoor under the floor, and unlike a bad location or a mismanaged inventory system, this one is happening to the entire industry at once, regardless of how well any individual store is run. Total beverage alcohol volume fell roughly 3% in the first half of 2025 alone, with beer down about 6%, spirits down 6%, and wine down 8.7%, as an entire generation of younger consumers shifts toward cannabis-infused beverages, non-alcoholic alternatives, and simply drinking less overall. This is not a temporary dip tied to one bad economic quarter. It is a structural shift in consumer behavior that has been building for years and shows no sign of reversing. Which means the fixed costs we just walked through, the rent, the refrigeration, the compliance fees, do not shrink even as the volume moving through your register slowly declines. Layered directly on top of that consumer shift sits a second risk, almost entirely outside any owner's control: regulatory structure. Some states run what are called control states, where the government itself sets prices and restricts what independent stores are even allowed to sell, while other states allow full competition but expose small operators to enormous category killer chains that can buy inventory at a scale no independent store can match. And because your liquor license itself functions as a transferable financial asset in quota-restricted states, its value can rise or fall based purely on regulatory decisions made by a city council or state legislature. Decisions you have no seat at the table for, that can instantly change what your single largest startup investment is actually worth. There is a third dimension to this trap worth naming directly because it compounds the first two rather than sitting separately from them. As overall category volume shrinks, competition for the customers who remain intensifies, which pushes chains toward exactly the kind of price-based warfare that squeezes independent operators hardest. Since a large chain can absorb thin margins on known value items far longer than a single location owner with 22 months of runway to protect. A shrinking pie combined with more aggressive competition for the remaining slices is a genuinely difficult combination for a small operator to outmanage through hard work alone. Let us talk about Bevmo, once the most recognizable specialty liquor chain on the West Coast, running 161 stores across California, Arizona, and Washington. In late 2020, delivery startup GoPuff, flush with SoftBank-backed funding and a nearly $4 billion valuation, acquired Bevmo outright for $350 million, framing the deal as a way to fuse Bevmo's retail infrastructure with GoPuff's rapid delivery network. On paper, this looked like exactly the kind of scale advantage independent liquor stores can never access on their own. A national logistics platform absorbing a beloved regional chain to build something bigger than either company could achieve alone. But the years that followed tell a very different story. Customers who had shopped Bevmo for its deep, curated selection of craft spirits and hard-to-find imports began noticing something unsettling. Entire sections of shelf space quietly replaced with generic convenience store items, coolers stocked with delivery app staples instead of rare barrel selections, and a product lineup shrinking toward exactly the same mainstream brands available at any grocery store down the street. The company's own buying teams, once known for sourcing special barrel releases and exotic imports, seemingly stopped doing the one thing that had differentiated Bevmo from ordinary retail in the first place. Meanwhile, competitor Total Wine kept expanding with 3 to 4 times the product selection in comparable locations. And Bevmo's value proposition simply evaporated. Stores began closing quietly, including long-standing locations like its Tempe Marketplace store, without much public explanation, and longtime customers openly noted that a chain built specifically around specialty selection had been hollowed out by an owner more interested in delivery logistics than curated retail. The lesson is not that acquisition itself destroys value. The lesson is that a specialty retailer's entire competitive advantage lives in a curated selection that costs money and expertise to maintain. And the moment a new owner stops investing in that specific advantage to chase a different business model, the customers who built that brand's reputation notice immediately, and simply stop coming back. Let us run the numbers on a typical mid-sized independent liquor store. Optimistic scenario against realistic bad year. In the optimistic scenario, your product mix leans toward a healthy proportion of wine and craft spirits rather than pure beer volume. Your known value pricing on familiar brands keeps foot traffic steady, and your discovery pricing on unfamiliar bottles quietly builds your blended margin toward the 28 to 35% range. On roughly $1 million in annual revenue, disciplined expense management can produce a net profit margin in the 10 to 15% range, translating to somewhere around $100,000 to $150,000 in annual take-home profit. And against a startup investment around $260,000, that supports a payback period in the 2 to 3 year range. Now the realistic bad year. Consumer volume across your core categories continues its multi-year decline, and your store, sitting in a beer-heavy neighborhood, cannot easily pivot its customer base toward the higher-margin wine and spirits categories fast enough to offset the loss. A Total Wine or a similarly scaled competitor opens within driving distance, undercutting your known value pricing on the exact popular brands that used to bring customers through your door, forcing you to either match their price and sacrifice margin or lose that foot traffic entirely. Your fixed costs, the rent, the refrigeration running 24 hours a day, the compliance fee, the insurance premium, do not move by a single dollar in response to any of this. Net profit margin can compress from that comfortable 10 to 15% range down toward 4 to 6%, or in a genuinely difficult year involving a serious new competitor and continued category decline, into an outright loss. The difference between these two scenarios on a single mid-sized store can easily exceed $80,000 in a single year. And for an owner who financed that license and build-out with meaningful debt, that swing is exactly the kind of gap that turns a comfortable debt service coverage ratio into a call from a nervous lender. So what is a liquor store, once you strip away the neon sign and the wall of familiar labels? It is a machine that turns a customer's familiarity with one product into an excuse to overpay for another, using the products they already know the price of purely as bait to walk through the door. The beer case is not really your business. It is your marketing budget dressed up as inventory. The real profit lives one aisle over, in the bottles nobody has a price memorized for, sold to customers who trust your judgment more than their own comparison shopping. You are not really buying a wall of bottles that never expires. You are buying a bet that enough of your customers will keep trusting your recommendation on the unfamiliar bottle in a country that is quietly, steadily drinking less of all of it every single year.